On September 15, 2008, the world watched a financial giant collapse in real time. Lehman Brothers, a bank older than most modern nations, went bankrupt overnight. Credit froze. Markets panicked. Governments printed money on a scale never seen before. And afterward, we told ourselves a comforting lie, that this disaster was new, that it was caused by modern complexity, that history had never seen anything like it. But that story is wrong, because 142 years ago, in the heart of Victorian London, the exact same collapse had already happened. Same confidence, same leverage, same denial, same panic, and the same terrifying realization. Money only works if people believe it will. In May of 1866, London was not just a city, it was the financial center of the world. The British Empire stretched across continents. Its trade routes wrapped the globe. Its banks financed ships, railways, factories, and governments. If money moved anywhere on earth, it moved through London first. And at the very center of that system stood one institution so trusted that its failure was considered impossible. Its name was Overend Gurney and Company. This is the story of how that belief destroyed an empire's financial system and quietly invented the modern bailout. For decades, Overend Gurney wasn't just respected, it was foundational. In the City of London, its approval turned paper into money. If Overend accepted a financial promise, the market treated it as gold. If Overend vouched for a borrower, no one asked questions. It didn't advertise. It didn't chase attention. It didn't need to. Trust came automatically, and that trust made it dangerous. Overend Gurney was not a normal bank. Ordinary people didn't walk in to deposit savings. There were no shopkeepers or farmers lining up at counters. Overend Gurney operated one level above everyday banking in the wholesale credit market. Its business was debt. In the 19th century, global trade didn't run on cash. It ran on promises. A merchant buying cotton, coal, or iron didn't pay immediately. He issued a bill of exchange, a written promise to pay later, usually in 3 months. These bills circulated like money, but only if someone trustworthy stood behind them. That someone was Overend Gurney. A seller could take a bill to Overend, exchange it for cash at a small discount, and walk away immediately paid. Overend would hold the bill until maturity and collect the full amount. It was simple, conservative, and incredibly profitable. This quiet mechanism powered the Industrial Revolution, and Overend Gurney was the biggest player in it. At its peak, the firm's turnover rivaled the national debt of Great Britain. People said it was as safe as the Bank of England itself. That reputation wasn't built on hype. It was built on fear. The firm was originally run by Quaker bankers who believed risk was a moral failure. They avoided speculation. They rejected anything they didn't fully understand. They knew their borrowers personally. Their power came from restraint, not ambition. For decades, this caution worked, and then, without anyone quite noticing, it disappeared. By the 1950s, the founders were gone. Control passed to a new generation, heirs who inherited immense wealth and an untouchable name. They didn't see Overend Gurney as a guardian of stability. They saw it as a wasted opportunity. To them, bill discounting looked small, old-fashioned, safe in the way cemeteries are safe. The world around them was changing. Steamships were shrinking oceans. Telegraphs collapsed distance. New laws allowed investors to take risks without losing everything. Capital flooded into ambitious ventures, promising extraordinary returns. And Overend Gurney was at the center of it all, with almost unlimited access to money. This was the temptation, because a bank that is trusted can borrow endlessly. and a bank that can borrow endlessly can convince itself that tomorrow will always fix today's mistakes. Overend Gurney began borrowing short-term money from other banks, funds that could be withdrawn at any moment, and lending it long-term to risky projects that might not pay off for years. This mismatch looks harmless, it feels manageable, until confidence breaks. Instead of financing reliable merchants, Overend Gurney poured money into speculative ventures. Railways without completed tracks, steamship companies without ships, industrial projects with no proven output. Due diligence collapsed. Optimism replaced caution. In effect, the firm stopped behaving like a conservative financial intermediary and started behaving like a reckless investment fund. But unlike modern investors, it wasn't risking patient capital. It was risking borrowed money. Money that belonged to other banks. Money that could vanish overnight. To manage this growing web of speculation, the partners hired a man they believed could rescue troubled investments and extract value from chaos. His name was Edward Watkin Edwards. He presented himself as a fixer, a man with connections and vision. In reality, he accelerated the collapse. Edwards pushed money into increasingly dubious schemes. He took secret commissions. He disguised failure with complexity. Instead of stopping losses, he multiplied them. By the mid-1860s, Overend Gurney's balance sheet was rotting from the inside. On paper, the firm still looked immense, millions of pounds in assets, a name that inspired unquestioned trust. But many of those assets were illiquid. Some were worthless. Others were outright fraudulent. The firm wasn't suffering from a temporary shortage of cash. It was insolvent. And yet, the outside world saw nothing wrong. This is the most dangerous moment in any financial crisis, the moment when insiders know the truth, but the public still believes the myth. The partners could have admitted failure. They could have unwound positions. They could have limited the damage. Instead, they chose denial. They convinced themselves that time would fix everything, that markets would turn, that their reputation alone would carry them through. To buy that time, they made a fateful decision. In 1865, Overend Gurney went public, and unknowingly, the public stepped directly into the blast zone. In 1865, when Overend Gurney transformed itself into a public company, the timing could not have looked better from the outside. Britain was in the middle of a financial boom. New companies were forming almost daily. Railways, shipping lines, mining ventures, overseas infrastructure projects, all promised growth, dividends, and national pride. The recently expanded system of limited liability meant ordinary investors could now buy shares without risking complete ruin. For the first time, finance felt accessible. And few names inspired more confidence than Overend Gurney. When the prospectus was released, it leaned heavily on that reputation. It painted a picture of stability, profitability, and continuity. This was not presented as a risky investment, but as a safe one, a steady income stream backed by one of the most respected institutions in the City of London. The public responded exactly as the partners hoped. Money poured in from across the country. Clergymen invested parish savings. Retired officers put in their pensions. Widows seeking reliable income bought shares, believing they were purchasing security itself. Applications exceeded expectations. Millions of pounds flowed into the firm. What investors did not know was that this money was not building a stronger institution, it was patching a sinking one. Instead of being used to expand sound operations, the new capital disappeared into the firm's balance sheet. Old losses were covered, bad loans were hidden, immediate obligations were met just long enough to maintain appearances. The transformation into a public company did not solve Overend Gurney's problems,
it postponed them. In modern terms, the firm was no longer operating as a business. It was operating on momentum. As long as confidence remained intact, it could keep going. But if that confidence cracked even slightly, the structure would collapse under its own weight. And confidence, once tested, rarely survives. By early 1866, the financial environment began to shift. Interest rates started to rise. Credit, which had been cheap and abundant for years, became more expensive. Speculative ventures that depended on constant refinancing suddenly faced pressure. Projects that had survived on optimism alone began to fail.
One by one, the weaknesses hidden inside Overend Gurney's portfolio were exposed. Railways missed payments. Overseas ventures stalled. Industrial schemes failed to generate returns. Assets that looked impressive on paper revealed themselves to be difficult or impossible to sell. The firm was holding promises that no longer inspired belief. Inside the City of London, there was a group uniquely equipped to notice these changes: bill brokers. These men lived inside the machinery of credit. They traded debt for a living. They judged the quality of paper not by headlines, but by patterns. They saw which names kept appearing, which ventures needed constant refinancing, which bills took longer to clear. And they began to notice something troubling. Overend Gurney's paper didn't look as strong as it once had. At first, this awareness spread quietly. There were no announcements, no accusations, just subtle shifts in behavior. Lenders became cautious. Short-term money was rolled over less eagerly. Questions were asked that hadn't been asked before. That was enough, because Overend Gurney's entire business model depended on uninterrupted access to short-term funding. It borrowed money that could be withdrawn overnight. The moment lenders hesitated, the clock started ticking. The firm's share price began to drift downward, not collapse, drift, a signal rather than a siren. The partners responded with reassurances. Publicly, they insisted everything was under control. Privately, they hoped the market would stabilize before pressure became unbearable. This is where crises turn deadly. When reality gives institutions time to react, they often choose delay over resolution. Admitting trouble feels more dangerous than pretending stability. And Overend Gurney had something few institutions were willing to abandon: its name. The partners believed that reputation itself was a form of capital, that the market would hesitate to doubt them, that time would restore confidence before withdrawals reached a critical level. But reputation cannot generate cash. By May of 1866, the situation had become desperate. Withdrawals increased. Creditors demanded repayment. Assets could not be sold without exposing massive losses. The math no longer worked. Overend Gurney needed liquidity immediately. There was only one institution capable of providing it: the Bank of England. At the time, the Bank of England was powerful, but not yet the omnipotent backstop we imagine today. It held gold reserves, it issued banknotes, and in moments of stress, it was the final source of stability. On May 10, 1866, a delegation from Overend Gurney walked into the Bank of England's headquarters on Threadneedle Street. They asked for an emergency loan, hundreds of thousands of pounds, enough to cover the immediate run and restore confidence. They offered their assets as collateral. This was the last possible escape. If the bank agreed, the crisis might stop before it became public. Confidence could be restored. History would barely notice the danger. If the bank refused, the collapse would be immediate. The governor examined the collateral, and what he saw made the decision unavoidable. The assets were not temporarily illiquid, they were fundamentally bad. Speculative railways with no revenue, shipping ventures that existed mostly on paper, loans to enterprises already failing.
This was not a short-term cash shortage, it was insolvency. Lending against these assets would not stabilize the system. It would merely delay the failure of a broken institution and transfer the losses to the bank itself. The choice was brutal. Save Overend Gurney and risk recklessness everywhere, or let it fail and risk panic across the entire financial system. The Bank of England chose discipline. The loan was refused. The delegation left Threadneedle Street knowing what the refusal meant. There was no alternative source of funding, no private rescue, no hidden capital waiting in reserve. At 3:30 that afternoon, a clerk placed a handwritten notice in the window of Overend Gurney's offices on Lombard Street. We regret to announce that a severe run on our deposits and resources has compelled us to suspend payment.
In that moment, one of the most trusted institutions in the world ceased to exist. The reaction was immediate. Telegraph wires carried the news across Britain within hours. Financial centers in Liverpool, Manchester, and Glasgow learned of the collapse the same day. By evening, disbelief had turned into fear. Because Overend Gurney had not failed alone, it had borrowed from hundreds of banks, insurers, and private investors. Its collapse froze their money instantly. Those institutions now faced their own liquidity crises, and as fear spread, depositors began to ask the same question everywhere at once. Is my bank next? This is how contagion begins, not through facts, but through expectations. People don't wait to confirm exposure. They act on the possibility that others might act first. By the time London went to sleep that night, the panic had already taken root. And when the city woke up on Friday, May 11th, 1866, it would discover that confidence, once broken, does not fade quietly. It explodes. Friday, May 11th, 1866 began with disbelief. London woke up hoping the rumors were exaggerated, that the suspension was temporary, that some quiet rescue had happened overnight, that the name Overend Gurney still meant what it always had. It didn't. The doors on Lombard Street remained shut. The handwritten notice was still there. And as the reality settled in, the city tipped from shock into fear. By mid-morning, Lombard Street was impassable. Crowds gathered in waves rather than lines. Creditors, depositors, investors, onlookers, people with money trapped inside Overend Gurney, and people suddenly terrified that their own banks might be next. Windows were smashed. Police were called. What had been the calm heart of global finance turned into something closer to a riot. This was not an orderly bank run. It was panic. Overend Gurney had been woven deeply into the financial system. Smaller banks parked excess cash there. Insurance companies relied on it for liquidity. Merchants treated its paper as unquestionable. When it collapsed, that money froze instantly. And because banking is a chain of promises, one broken link was enough to snap the entire system. The panic spread outward almost immediately. Other discount houses were targeted next, the Joint Stock Discount Company, the Bank of London. One after another they came under pressure as depositors demanded cash, not assurances, not promises, but physical notes backed by gold. Fear moved faster than information. A short walk away stood the Bank of England. Its stone walls and guarded entrance suddenly became the focus of the crisis. If Lombard Street represented collapse, Threadneedle Street represented survival, and the Bank of England was under siege. Crowds gathered outside. Institutions sent urgent requests. Gold reserves were watched closely. Every withdrawal raised the same terrifying question: what happens when the gold runs out? The problem was not just financial, it was legal. The Bank of England was bound by the Bank Charter Act of 1844. This law limited how many banknotes it could issue based on its gold reserves. It was designed to prevent reckless printing and enforce discipline. No bailouts, no bending the rules, even in a crisis. In theory, it was sound money. In practice, it was a trap. Because the panic was accelerating. If the bank followed the law perfectly, the entire British credit system would collapse. Trade would freeze, wages would go unpaid, businesses would fail, not because they were insolvent, but because cash had vanished. Doing nothing was not neutral, it was catastrophic. Inside the Bank of England, the realization set in that Overend Gurney had already been punished. Its failure was complete. Allowing the panic to continue would punish everyone else, merchants, workers, and institutions that had behaved responsibly.
At around 3 o'clock that afternoon, with the city on edge, the bank's directors made a decision that would redefine finance forever. They went to the government. They asked for permission to break the law. Specifically, they requested a temporary suspension of the Bank Charter Act. This was extraordinary. Suspending the act meant publicly admitting that the nation was in a financial emergency. It meant abandoning decades of hard money orthodoxy. It meant accepting responsibility for the entire system. The government agreed. Within hours, a letter was issued authorizing the Bank of England to issue as many banknotes as necessary, even without gold backing, and to lend freely to any solvent institution that could provide good collateral. This was the birth of the modern lender of last resort. The distinction was crucial. Overend Gurney would not be saved. Its recklessness had crossed the line from illiquidity into insolvency. But the market, the network of otherwise sound institutions, would be protected. With that promise, the panic broke. The effect was almost immediate. As news spread that unlimited liquidity was available, confidence returned. Withdrawals slowed. Crowds dispersed. Firms that had been hours away from collapse survived. Over the following weeks, the Bank of England issued millions of pounds in emergency loans, enormous sums for the time. Yet the suspension of the law lasted only days. Once confidence stabilized, the extraordinary powers were quietly withdrawn. The crisis ended, but the consequences did not. Because something fundamental had changed. For the first time, a central bank had openly accepted responsibility for stopping financial panics, not as a participant in markets, but as their backstop. Not as a guardian of rules, but as a guardian of confidence. This decision saved the British economy. It also planted a dangerous idea, that in a true crisis, the system would be protected, and that belief would shape behavior for generations. The panic faded from the streets, but its human cost was only beginning to surface. Unlike modern investors protected by full limited liability, many shareholders of Overend Gurney faced a brutal reality. Their shares were only partially paid. When the company collapsed under massive debts, the law demanded the rest. The bills arrived months later. Clergymen sold their homes, widows lost their savings, retired officers were dragged back into work. Families who had never speculated in their lives found themselves responsible for the reckless decisions of men they had never met. London's suicide rate spiked. Newspapers filled with stories of quiet ruin. The Victorian financial class had been built on an assumption that now lay in pieces, that a gentleman's word was as good as gold. Public outrage demanded punishment. If the system had been saved, someone still had to answer for the destruction it left behind. In 1869, 3 years after the collapse, the surviving partners of Overend Gurney were put on trial at the Old Bailey. They were charged with conspiracy to defraud the public. The prosecution argued that the prospectus issued in 1865 was knowingly false, that the partners had raised capital not to strengthen the business, but to bury losses they already understood.
The trial became a national obsession. Newspapers printed daily updates. Crowds gathered outside the court. This was the Victorian era's equivalent of Enron or Lehman, a public reckoning with the limits of trust and the cost of unchecked confidence. The evidence was damning in spirit, if not in law. The firm had been insolvent when it went public. The risks had been concealed. The optimism had been reckless. But proving criminal intent was far harder. The partners' defense was simple and unsettling. They claimed they were not criminals, they were optimists. They argued that they genuinely believed the business could recover, that markets would turn, that time would heal the damage. They insisted they had not intended to deceive, only to survive long enough for their faith to be rewarded. Under the standards of the time, that distinction mattered. The jury acquitted them. They walked free. The verdict shocked the public, but it revealed something important about finance that still holds today. The line between fraud and recklessness is often thin, and the law struggles to draw it. Confidence can look like deception only in hindsight. The partners avoided prison. They did not avoid judgment. Their reputations were destroyed. Their wealth was gone. Their names became synonymous with ruin. They lived out their lives as cautionary examples, men who confused confidence with competence and optimism with solvency. Yet from this wreckage, something extraordinary emerged. Watching the events of 1866 unfold was a journalist and thinker named Walter Bagehot. From his position at The Economist, he studied the panic closely. He saw that the Bank of England had ultimately done the right thing by flooding the market with liquidity, but only after a dangerous delay. He understood something that most policymakers still resist. Financial crises are not caused by a lack of money. They are caused by a lack of confidence. In 1873, Bagehot published a book titled Lombard Street. It would become one of the most influential works in the history of finance. In it, he distilled the lessons of Overend Gurney into a simple rule for central banks facing panic. Lend freely, at a high rate, against good collateral. This principle became known as Bagehot's dictum. It was revolutionary because it drew a clear line. Central banks must act decisively to stop contagion, but they must not rescue insolvent institutions or reward recklessness. Liquidity should flow to the system, not to failed bets. Fear should be extinguished, but discipline should remain. This philosophy was born on Black Friday, and it traveled far beyond Britain. When the Federal Reserve was created in the United States in 1913, it was shaped by these ideas. When the Great Depression struck, policymakers returned to Bagehot's logic. And when the global financial system froze in 2008, central bankers openly cited his work as they unleashed trillions of dollars to prevent another collapse. The tools were modern, the logic was Victorian. But there is a darker lesson embedded in 1866, one that keeps repeating. Overend Gurney was not a traditional bank. It was a shadow bank. It operated outside the strict rules governing deposits and reserves. Its innovation hid risk. Its complexity disguised leverage. Its size created the illusion of safety. So did Lehman Brothers. In 1866, the toxic asset was a fraudulent bill of exchange. In 2008, it was a subprime mortgage bond. In the future, it may be something else entirely: private credit, algorithmic leverage, or digital assets wrapped in reassuring language. The form changes, the psychology does not. Financial crises almost always begin in the shadows, where regulation lags innovation and confidence outruns understanding. Institutions borrow short-term money to make long-term bets, assuming liquidity will always be there. When it isn't, They discover too late that reputation cannot pay debts. The collapse of Overend Gurney also exposed the eternal problem of moral hazard. By saving the market in 1866, the Bank of England prevented economic collapse. But it also taught surviving institutions a dangerous lesson. In a true panic, the system will be protected. That knowledge encourages risk. Bagehot insisted that emergency lending should come at a high interest rate precisely to counter this effect. Bailouts were meant to hurt. They were meant to stabilize the system without rewarding those who caused the danger. Over time, that discipline weakened. Modern rescues often protect shareholders and executives, not just commerce and depositors. We remembered how to lend freely. We forgot how to punish recklessness. And that omission has made the system more fragile, not less. Today, the City of London is filled with glass towers, fiber optic cables, and algorithms trading at the speed of light. Wall Street looks nothing like Lombard Street did in 1866, but beneath the technology, the foundation is unchanged. It is still built on belief. Belief that tomorrow will come. Belief that markets will remain liquid. Belief that someone will step in when confidence breaks. The story of Overend Gurney is not ancient history. It is a mirror. It reminds us that size is not safety, that reputation is not solvency, and that panic, not logic, is the fastest force in finance. The men of 1866 forgot this. The bankers of 2008 forgot this. The question is not whether it will be forgotten again. The question is, who will forget it next? The collapse of Overend Gurney was the moment capitalism lost its innocence, the moment the invisible hand faltered and the visible hand of the state stepped in to stop total collapse. We have been arguing about that intervention ever since, but whether bailouts are seen as a necessary evil or a moral failure, one truth remains. The financial world we live in today was forged on a single Friday in May 1866. The panic is gone. The buildings have new tenants, but the emergency lever is still there, behind glass, waiting for the next hand desperate enough to pull it. And history suggests that eventually someone will.